Hello, folks. Welcome to the top of the hour. My name is Mark Johnston. I'm your host here at VID5 and our VID conference series brought to you by our sponsor, Laurentian Bank Securities. And as it is the top of the hour, we have a new guest to join us for the next 45 or so. And we have the great pleasure of welcoming Spencer Cole, Chief Investment Officer of VOX Royalties. Spencer, how are you?
Very well, thanks, Mark. How are you doing?
Very good, thank you. It's been a chunky day, but a very good day with lots of engagement with our audience. So I will step out of your way for the presentation and come back around for the question period.
Fantastic. Thanks, Mark. Well, thanks so much for everyone's time. It's a pleasure to chat with you today and share a little bit about VOX Royalties' unique business model. Apologies up front for my unfortunate Australian accent. For those Canadian listeners, I hope you can still understand most of the words that are coming out of my mouth. So a little bit about VOX Royalty. The company was established 8 years ago, so significantly before a lot of the newer entrants to the royalty industry. But we only listed on the TSX Venture Exchange about 18 months ago. So still a relatively new name from a capital markets perspective, but importantly have been allocating capital to mining royalties for the better part of the last 10 years. I guess, we get the question all the time, another royalty company. Seems like you guys are growing on trees at the moment. But I think some of the points I want to leave you with today are that, VOX has been around almost 10 years, and we've created a business that is truly differentiated. Everyone likes to say that their business is unique and differentiated, but what I hope to leave you with today is a few aspects of our business model that truly are differentiated and what we believe, are world-class. Because ultimately what we're targeting as a company we're targeting the highest return on invested capital within our entire industry. That's from the newcomers all the way up to Franco-Nevada. Our aspiration is to have a higher rate of return on our investments than anyone in our industry. And how we're doing that is using a technically focused management team and leveraging the world's largest proprietary database of mining royalties, of over 8,000 royalties, which is a database we've created over the last 10 years. So without further ado, I'll kick off. I will be making some forward-looking statements in today's presentation, so I would refer you to the disclaimer on the VOX corporate presentation on our corporate website. So today I'm really just going to talk about four things. Firstly, I'll talk about a little bit about VOX and our unique business model. Secondly, I'll address a few misconceptions within the capital markets around royalties versus equities, and specifically through two key questions. Then thirdly, I'll talk a little bit more about our unique strategy, or what we like to call event-driven royalty acquisitions. And then fourthly, I'll just finish up on talking about some of the upcoming exciting catalysts that we have in front of us at VOX. The chart on the right-hand side of this slide really is where the rubber hits the road for VOX. We pride ourselves in being a very capital-efficient business model targeting excess rates of return. So what does that actually mean? What it means is we've deployed $32 million of capital to create our portfolio of 54 royalties. And now that has a market value of approximately $143 million. So that is success for us, continuing to deploy capital on undervalued royalty assets that are really attractive so that we can unlock a significant multiple for on our capital invested for our investors. So a little bit about VOX. As I mentioned, we were established 8 years ago, but we only went public 18 months ago. So still is very much a ground floor opportunity. And over those 8 years, we've amassed a portfolio of 54 royalties that are biased heavily towards precious metals and Australia. So 70% of our royalties are precious metals weighted, and the other 30% commodity-wise are across base metals and some battery metals and a little bit of iron ore. And then from a geographic perspective, our portfolio has been constructed with very low geopolitical risk in mind. So 80% of our royalty assets are located in Australia, Canada, and the United States. And we're actually the second largest holder of hard rock mining royalties in Australia. second only to Franco-Nevada. It's been a fantastic growth market for us over the years. We have been delivering exponential revenue growth for our investors. So in the last 5 quarters, quarter on quarter, we've generated about 350% quarterly revenue growth. And that's, that high growth is set to continue. We currently have 5 producing royalty assets. And by the end of 2023, we expect that will organically grow to, 10 plus producing royalty assets based on operator disclosure. And then, as I touched on before, our management team is heavily technical in nature. We're a team of mining engineers and geologists at the front lines of the business, properly understanding both the risk and the reward in the mining royalties that we're acquiring. We're not just blindly putting numbers into a spreadsheet. And importantly, as a management team, we own 15% of the company ourselves, and our families own, north of that 15% as well. So everything we do is through the lens of shareholders ourselves, and we're fully aligned with our register of investors. A little bit about our cap structure. We have a very tight capital structure. We've got less than 40 million shares on issue, very few warrants out. We're about $140 million market capitalization with about $9 million of working capital in cash and listed investments on the balance sheet. We have a growing register of institutional investors. Some of the who's who of long-only precious metal funds bought into our most recent capital raising in March of this year. And then, importantly, the family offices that seeded the company back in 2014 still hold a meaningful part of the register. And they've been so aligned with management that they haven't sold a single share since they initially seeded the company back in 2014. What really does make VOX different, as I touched on, there's approximately 30 different listed royalty companies out there, with a combined market cap of about $70 billion. So it is an industry that has become quite crowded in recent years. But the good news is, VOX was created 8 years ago, knowing full well that the industry was going to get crowded. So we've deliberately built a company that is differentiated against the rest of the crowd. And one of the key sources of differentiation is our unique intellectual property. So over the last 10 years, we've built a database that has over 8,000 proprietary royalties in it. And we use that database to find completely hidden pockets of value in royalties. So for example, we use that database we bought a producing iron ore royalty from a telecommunications company. We bought another gold royalty from a hearing aid company. We bought another gold royalty from an automotive parts company. Now, you might be scratching your head and saying, why the hell would these non-mining companies hold mining royalties? And that's a great question. But I guess that's part of the informational edge or advantage that we have with this database, is that we can continue hunting for royalties where our competitors aren't anywhere to be seen. The second key competitive advantage that I touched on a little bit earlier was our technical management team. So because we're a team of mining engineers and geologists, we're obsessive about understanding both risk and reward. So we're not the type of team just to pick up a feasibility study or a PEA and just blindly put those numbers into Excel and then send off an offer to the royalty holder. We are quite extremely diligent on understanding every single technical risk. And I'll touch on this in a later slide as we talk about, how do we see royalty value truly being created. And then lastly, we focus on accretive or value-adding deals across all metrics. So does this add value on a per share basis for new deals, on a net asset value perspective, on a cash flow per share perspective, and ultimately a return on invested capital perspective. We're not in the business of trying to sort of solve returns for one metric, like trying to have the highest revenue at any cost or trying to have the highest net asset value at any cost. We think, any successful business, irrespective of what industry you're in, you need to really focus on on creating value for shareholders across all of these key metrics, because if you're slavishly focused on just revenue or just net asset value, and you're not looking at truly per share value and increasing that over time, it's a flawed business model. So we are quite obsessive about return on invested capital. A little bit about VOX's global royalty portfolio. As I touched on before, we have 54 royalties globally, and they're weighted in two key areas. Firstly is to precious metals, which is 70% of our portfolio, and the second is to Australia, which is also about 70% of our portfolio is weighted towards Australia. So importantly, outside of precious metals, we are quite opportunistic across hard rock commodities. So if we see an undervalued copper royalty, or if we see an undervalued vanadium royalty, or even iron ore royalty, we will chase that value for our investors. We won't just slavishly say we only touch gold royalties. We're in the business of ultimately acquiring undervalued and attractive royalties for our investors to create long-term shareholder value. Now, that will probably trend to be 70+% precious metals, just because there are more precious metal royalties out there. But ultimately, we're in the business of creating value by acquiring hard rock mining royalties for our investors. From a stage of development perspective, we have 5 producing royalties currently, but importantly, we've got another 15 royalties that are in varying stages of development. Some are in construction phase, others are in earlier stages of engineering. But as we project ahead, based on operator guidance, by the end of 2023, we expect that organically, our portfolio will grow from 5 producing royalty assets to 10 producing royalty assets based on the projects that are in construction or pre-construction currently. So investors buying into VOX today just get a huge volume of organic growth without a single dollar of additional capital required for new royalties. So that theme of embedded organic growth is a really attractive theme that's brought a lot of new investors into VOX over the past 6 to 12 months. Now, I'll touch now on, I guess, a few misconceptions that some investors hold. This slide is looking at, I guess, the question that we've received from some mining or resource investors that, why do I need to buy a royalty company? Why can't I just buy the mining equities from miners that I like? Surely that's a better way for me to selectively choose which mining assets I want to get exposure to, rather than buying a company like VOX that has 54 separate royalty assets. Now, what we've done here on this slide is I guess just to address that misconception is, we prepared a case study looking at one royalty acquisition that was done in June of 2011 to compare on a like-for-like basis if this was done as a pure equity investment in the producing gold miner versus if it was done as a royalty investment. So what you see here is Franco-Nevada in June of 2011 acquired a 1.5% revenue royalty on the Edikan gold project in Ghana that's operated by Perseus Mining. Now, what we've done here is we've said, okay, instead of acquiring that royalty for $35 million, what would the returns have been if an investor had invested $35 million into the equity of Perseus Mining? Now, an investor investing $35 million into the equity of the actual operator would have had about 3.2% of the actual ownership of Perseus Mining if they made that investment on the same date in June 2011. Franco-Nevada, by comparison, they were entitled to 1.5% of revenue. Now, fast forward 10 years, the Edikan mine has produced approximately 1.9 million ounces of gold and still has, north of 1 million ounces of reserves left in the ground. And what have the returns been, for a potential equity investor versus a royalty investor? So we'll start with Franco-Nevada. Franco-Nevada has received over $40 million US in royalty revenue over that 10-year period. Now, unfortunately, based on their dividend policy that has only just commenced, an equity holder would have received effectively $145,000 in dividend payments on that shareholding in Perseus Mining if they had bought the equity. Now, similar to a lot of other mining companies, Perseus has had numerous equity issuances through that 10-year period. So the equity holder would have been diluted from 3.2% of the company down to 1.1% of the company. So they would have been diluted about 65%. Over that same period, obviously Franco-Nevada's royalty is revenue linked, secured against the asset and the claims. So they've had 0% dilution. So I guess this just gives you a brief snapshot on a like-for-like basis of the benefits of a royalty over call it a 10-year horizon as it relates to dilution and the revenue generation potential that royalties on the right assets can create. So while this is not representative of every mining company or every mining royalty, we think it shows a good illustration of, I guess, the benefits of no dilution that royalties offer, and the cash flow generation potential they can also offer, when the royalties are over the right assets. The next, I guess, investor misconception or question mark that we wanted to address was what truly does create or destroy fundamental royalty value. And so there's two aspects to this slide that I'm keen to run through. The first is all the text up the top. So at VOX, we firmly believe that what ultimately creates and destroys value, fundamental value with a royalty, it starts and often ends at the technical aspects of the mining project. So where we've seen the biggest losses on royalty investments, typically they fit into three key buckets. The first is linked to permitting outcomes. So in recent years, we've seen obviously the headwinds from a permitting perspective. So mining companies that are trying to get new greenfields projects permitted in jurisdictions such as Argentina and more recently in Minnesota, obviously an adverse permitting outcome can completely, I guess, destroy value linked to a royalty if it changes the fundamental probability of that asset being developed. Secondly, poor engineering study outcomes. So we've seen a number of feasibility studies and pre-feasibility studies come out in recent years where it might be the metallurgy is highly complicated, or there are groundwater issues. As many operators know, with groundwater, you've either got too much water or too little water. It's rarely somewhat in the sweet spot in between. Or there can be issues with the underlying ore body or how amenable it is to being mined. And then lastly, the third source of sort of value destruction that we've seen in the royalty industry is, I guess, some of the newer royalty companies potentially reaching for new royalty acquisitions and participating aggressively in royalty auctions run by investment banks. And look, it goes without saying that if you trying to win an auction and if you use a long-term commodity price assumption that is closer to spot prices rather than a long-term consensus assumption, you're setting yourself up for failure. So we have seen a number of impairments linked to groups overpaying for royalty assets in auctions. Now, on the upside, what are sources of value creation? Ultimately, that we as VOX management really focus on. And I've included a few examples of specific royalties here where we've seen this play out. Resource upgrades. So, our team of geologists will look through all the historical drilling and then come up with an internal view on what the resource estimate could be. And now we won't typically price that into our bid, but we'll have that as a sort of part of our internal due diligence. And we've seen that across multiple royalties play out where the size of the resource has expanded. Feasibility studies being expanded in size and scope. So at our Bowden Silver royalty in the last 6 months, they've hit so much high grade at depth, like it's already the largest silver project and ore body in all of Australia that's being developed. But they've hit so much high grade silver at depth, they've actually commissioned an incremental underground scoping study looking at an incremental underground operation that would complement the current proposed open pit. Other sources of value, upside or creation, we track events such as projects changing hands. So, for example, we bought a royalty at the start of last year called the Ashburton Gold Royalty, which covers a 1.65 million ounce gold deposit. Now, to be perfectly honest with you, that project was very sleepy at the start of last year, but our hypothesis was if this project changes hands into a more nimble and motivated junior operator, the value of the royalty will be re-rated. And then sure enough, within 6 months of us acquiring this royalty, the project was sold from Northern Star Resources to a very a well-credentialed junior operator called Kalamazoo Resources. So that change of ownership can create a huge amount of value as a project goes from being mothballed to the flagship royalty asset. And then lastly, one of the other key sources of value creation that we focus on when we're looking for new royalties is production upside and expansion potential. So, it's one thing to buy into a producing royalty that may have upside in 10 or 15 years' time to extend the mine life. But what we get really excited about at VOX is if there's potential for the production rate to be expanded by 20, 40, 60, 100% in some cases next year, because then all that cash flow obviously accrues to our shareholders much quicker. So, for example, our Janet Ivy Gold Royalty, we received intelligence that the mining operator was about to commission a major expansion, a $460 million expansion at that mine, and which would effectively increase the royalty production rate by 10 times. And so sure enough, within 3 to 6 months of us acquiring that royalty, that's played out, and we've got a huge amount of volume upside as that project is expanded going into next year. Old Tear is another example of this. At our producing iron ore royalty, they've commissioned a second open pit, which has substantially increased royalty-linked production. And then at our Higginsville Gold Royalty, Karora Resources is aggressively expanding their mill. So we see volume upside there as that royalty progresses. And just the last part of this slide is we just compiled a chart which is the price to book ratio of a select group of royalty companies. Now, you might say, what the hell does price to book really mean for royalty companies? This is an interesting metric where it is effectively a ratio of saying how much of these companies paid for royalties on their balance sheet relative to how much value the market ascribes to their royalties. So almost like an index of overpaying versus underpaying for royalties. So VOX is currently trading at about 4.4 times price to book. So it basically means for every dollar that we've invested into royalties, it's created about $4.4 worth of market value. And what you see in this chart is we've also segmented it based on how long these different companies have been acquiring royalties for. And so what you see on the right-hand side of the slide is the companies shaded in black are companies that have been investing in royalties for over 5 years. And so unsurprisingly, a lot of those companies historically have been the most successful at attractively at pricing deals, so making capital efficient investments and then getting a huge amount of a multiplier effect in terms of the market value created from each dollar invested. So we plot really well on this chart, and we expect to keep that capital discipline long into the future. Now, my third point, just around part of VOX's strategy. So I've touched on this in a few different ways in earlier slides, but a key part of our business is what we call event-driven acquisitions. So we're looking for interesting royalties that we typically buy from prospectors and juniors who made the original discovery and then were given a royalty when they sold the mining project years ago. We're looking for royalty projects that are right on the cusp of a major event. So either right about to go into production or just about to move into construction, for example. Because what we see is that's the point at which, call it 3 months from first production to 24 months from first production, where we can price deals, in our favor using our technical management team, and where we can, if we price the deal the right way and we truly understand the technical risks the right way, we can get the highest sort of multiplier effect on our capital invested for the benefit of our shareholders. So these are 4 separate deals that we've done in the last 2 years on 4 different gold royalties, where within 3 to 18 months, we've seen major events hit, as we expected during due diligence, that have fundamentally re-rated the value of these royalty assets, whether it's a resource upgrade or a pre-feasibility study being released on the Mount Ida royalty, or at Ashburton. As I touched on, the project changed hands and went from being a mothballed project to a flagship asset of a new operator. Or at Higginsville, we expected that royalty could come into production within 12 months. Now, within 3 months, we were surprised on the upside that Karora had effectively commenced mining on the royalty property. And at Janet Ivy, a gold royalty that we acquired in March of this year, as I touched on, a major expansion has been commissioned within the first 6 months of us acquiring this royalty, which will transform this royalty asset into Australia's largest gold heap leach operation, within the next 18 months. So event-driven acquisitions is a key part of VOX's strategy to create sustainable long-term value for shareholders. So lastly, I just wanted to touch on, on upcoming catalysts and milestones that investors can expect for VOX. The first is around rapid organic growth. So we went public, as I touched on, May of 2020. And look, I'll be honest with you, one criticism at the time was we only had one producing royalty asset. So, a number of investors said, how excited can I get about one producing royalty asset? Our feedback to that question has been quite consistent. It's been, we're finding royalties that are right on the cusp of production. So watch this space. Within months and quarters, we expect to be at a multiple of that number of producing royalty assets. We've delivered on that commitment to investors. So we've grown from one producing royalty asset when we went public last year to 5 producing royalty assets today. Based on operator guidance, we expect late next year that will organically increase to 7 producing royalty assets. And then by the end of 2023, we expect that will increase to 10 or potentially north of 10 producing royalty assets based on operator guidance. And then obviously from a revenue perspective, as those new royalty assets come into production, we expect to continue seeing a huge amount of organic revenue growth that will be for the benefit of our VOX shareholders. So what other catalysts are there for VOX investors to look forward to? So I touched on the exponential revenue growth that we've already delivered on in recent quarters and is expected by analysts to continue. I've touched on the number of producing royalty properties and the organic growth we expect to have in that over the coming quarters. This third point, disciplined royalty acquisitions. As I've hopefully shared with you today, we are obsessively focused on return on invested capital. And so as we project ahead over the coming months, we are working on some really exciting and interesting royalty deals. So we expect to announce a number of really interesting and attractively priced royalty deals to the market, in coming months and quarters. And then this last point, I think we're extremely grateful to the research team at Laurentian, having initiated independent research coverage on VOX in the last 2 months. That brings us up to 4 separate independent research analysts that currently cover VOX, and we're deeply grateful for all of that research coverage. And we are also looking at other sources of sort of capital markets awareness, and also looking at secondary listing exchange options as well. So with that, I'll bring my presentation to a close. Hopefully it wasn't death by PowerPoint, but I would strongly encourage listeners to ask me any question. I'd be really excited for this to become more of a conversation.
Wonderful. I appreciate that very much, Spencer. And the question column's been quite busy since you've been offering your insights to the audience. So we know that there's a great engagement happening here in a sizable room. So I'll ask if we can step back maybe and look around the industry a little bit before we come back around and focus specifically on VOX. Jacques asks a question here. As you look at the current landscape, Spencer, what forward-looking trends are you seeing in the royalty opportunity space for VOX and other juniors or intermediates?
Yeah, it's a great question, Jacques. I think the industry continues to evolve, and I think what we've seen amongst the 30 listed royalty companies is quite a bit of segmentation already. There's obvious segmentation based on commodity preference. So there is the pure precious metal groups, the groups that are sort of 70% precious metals, and then the groups that I guess are more commodity agnostic. And then likewise, we've seen quite a bit of segmentation in terms of groups focused on writing new royalty streams, new royalties and streams as a form of project finance, and then groups like us who are chasing more existing royalties from prospectors. We would expect that segmentation to continue to play out. I think that there's more than enough mining properties out there to support future royalties, both existing and new royalties. So we expect that segmentation to continue to play out. There has been some consolidation, obviously, at the junior end of the market. We would expect some of that consolidation to continue, because there are economies of scale benefits for sure. And then I think another trend we are starting to see is some innovation in terms of the royalty terms that people are introducing, and trying to get to, I guess, more equitable shares of upside and downside between royalty company and mining company. So, for example, historically it was more simplistic. Is it a top line revenue royalty or is it a profit linked royalty? I think now what we're seeing in the industry is a lot more sort of intermediate type structures that could offer upside linked to exploration success without the downside if the commodity price contracts. So we're seeing evolution in a number of those different areas.
Terrific. Great answer, Spencer. Thank you for that. Paul asked this question, Spencer, have you found the 54 royalties only via the 8,000 database or other channels as well? He's saying, of course, your 54 is less than 1% of the 8,000. How many of the 8,000 do you see as potentially convertible into royalties owned by VOX?
Yeah, it's a great question from Paul, and a question we receive from a lot of institutional investment funds. The first part of that question is, no, not all of the 54 royalties have come from our database. We have had numerous instances where, I guess, through our networks, we've been referred to new royalty deals. So, for example, we acquired a portfolio of 5 Western Australian gold royalties the start of last year, and then the managing director that we transacted with, he moved to a new company, and they had a portfolio of royalties, and it had such a good experience with us on the first royalty deal. He basically banged our door down on his new royalty portfolio and wanted to transact with us again. So I guess that sort of network effect of creating win-win type transactions has created a number of follow-on royalty opportunities for us. But I'd say the common element across all of our 54 royalties is there's an element of insight either from our royalty database. Either we sourced it directly from the database, or we use the database to augment our due diligence. I think the second part of the question of what percentage of the 8,000 plus royalties in our database are truly transactable. Look, it's a tough one to definitively pinpoint a specific number. I mean, royalties are typically created when prospectors and juniors sell mining claims. Now, the majority of claims that have been sold historically are over exploration properties. So in our database, there is a long tail of exploration royalties, some of which that are potentially sort of moose pasture that would probably be too early for us. But I'd say within the database, and certainly opportunities that we're in active dialogue on, there's at least a good 500 to 1,000 royalties that we would love to bring into our royalty portfolio. So no shortage in sight based on what's in there, and the database continues to grow every month. So I expect in the next 12 months it'll probably be north of 9,000 royalties in the database.
It's an evolving process. Absolutely. Thank you for that, Spencer. We have a question from Tom asking, what is your take, Spencer, on the roll-up potential of many of the newer royalty companies, and where do you see yourself in that process?
Yeah, so I appreciate that question, Tom. I think, you could ask this question of any royalty executive, and they'd say, when you look at a royalty or a portfolio of royalties, what do you really crave? What are you really most excited about? and I think for a lot of royalty executives, it's cash flow and near-term cash flow that is, it's not BS, it's real. And then the second part is sort of optionality, or sort of, leverage to exploration success and, the outcomes of development studies. So naturally within those two sort of subsets, there's a premium for companies that have current and near-term royalty revenue.
Yes.
And secondly, there is a premium for companies that have a robust portfolio of development stage royalties that are actively being worked towards production.
Okay.
So I think my personal opinion would be companies that offer both of those two. So companies that offer a baseload amount of revenue and cash flow, plus an accelerating sort of tidal wave of development news flow and royalties that have a credible and fighting chance of being progressed through development into production. I think companies that offer those two attributes are likely to be high up the list of people's sort of target list. So I think, unfortunately, there are some portfolios that are quite skewed towards early stage exploration. And for some of those portfolios, they may need a few more years to mature. But if for any company or portfolio that offers those two attributes of cash flow and development momentum, I'd say they'd be on a target list.
Okay, thank you, Spencer, for that. A question we're going to bounce back to Jacques here, who asked some interesting questions. Does VOX see opportunities, Spencer, in the streaming space as a bit of a departure from royalty positions?
Yeah, good question, Jacques. Look, I think VOX has been around for 8 years, as I mentioned, Mark, and the company did a few streams early on back in 2014, 2015. I think there's fundamental differences in terms of how you transact on royalties and streams. So if I take two like-for-like examples, one being a new stream over a project that's just about to come into production, and another one being an existing royalty on a project at a similar stage. The timeline and speed that you can transact on an existing royalty agreement versus creating a new stream, and then also, I guess the transactional objectives of the sellers are vastly different. So a mining company that's selling a stream is just looking for some extra capital, typically to finish construction, or if they've had cost overruns or technical issues commissioning the mine, they might need some extra capital from a stream. So their cost of capital expectations, generally can be quite aggressive, and the technical profile and risks of the project, they can be projects that are struggling because otherwise they wouldn't need to sell the new stream to get that last bit of capital.
Right.
Whereas at the other end of the spectrum, if you're buying existing royalties from prospectors and juniors, often they want a liquidity event so they can reinvest that money elsewhere. And when we're picking up an existing royalty contract, we can transact within a matter of weeks on that at much greater simplicity compared to writing and negotiating a brand new streaming contract from scratch. So I think for all those reasons, I think it's highly likely that we'll stay firmly focused on acquiring existing royalties.
Fantastic. Great share, Spencer. Thank you for that. I love this next question. What have been the biggest learnings for VOX since going public?
Yeah, so I think there's been a heap of learnings. We're a fairly young management team, despite being all in the royalty industry for 10 plus years each. I think some of the key learnings have been, I think from a capital markets perspective, if I focus on that, the company had been private for 7 years prior to listing May of last year. And I think, we'd invested so much into our business development engine, into our royalty database, and, we pride ourselves on being a world-class team at finding and acquiring royalties. But I'll be frank, we were largely completely unknown in Canadian capital markets. So when we went public last year, I think we expected the saying from that movie, "If you build it, they will come." We built it, and the liquidity did not come. So I think we underinvested in our capital markets awareness program. And then I think over the last 6 months, we put a much more sort of laser-like focus on our investor outreach and our capital markets program, and that has really, I think, translated into investor eyeballs. So I'd say that was sort of one source of a big learning. You can be the world's best company at finding and acquiring royalties, but if you're unknown in capital markets, the market won't reflect that value in your stock. I think another lesson that we've learned is just around exploration stage royalties and being quite careful with how early stage we go. I think sometimes it's easy to be seduced by looking at a certain operator and saying, that company seems to be making the right noises. But I think now our due diligence is much more careful, where, we scrutinize truly what dollars are being spent in the ground. When in previous years, if we saw a multi-billion-dollar operator, progressing a certain exploration property, we perhaps didn't, we placed too much reliance on that. So I'd say that's one learning from a business development perspective around how we evaluate exploration stage royalties.
Excellent. Thank you. And there's a bit of a piggyback question that comes from that share as well, Spencer. What would you say is the most misunderstood or undervalued aspect of VOX's business?
Yeah, so it's a good question, Mark. I'd say two key aspects. One would be, I think our Australian royalty portfolio still is misunderstood. When we went public last year, we had a lot of investors that said to us, Mark, they said, sounds like a really interesting business model, but most of your royalties in Australia are operated by ASX listed mining companies. And I don't know them. I've never heard of them. So I'm just going to write off a bunch of these. Now, in some cases, these were multi-billion-dollar ASX listed operators. And we thought, are you kidding? These are like some of the who's who of Australian mining companies.
Right.
So it was incredibly frustrating when we'd meet with investors and they'd say, just get more TSX and TSX venture listed, operated royalty assets. And we said, well, we find great value in Australia buying royalties in Australia. So isn't that the best place to keep, deploying capital? So I'd say in recent months, the tide of that has slowly started to turn, where investors have started to understand some of the embedded value in our Australian royalties. But I still think we've got a way to go there. So I'd say that's one element of our business that's not fully understood and not efficiently valued. The other aspect is, what is the value of our database, and what is the value of being able to get our hands on royalties at incredibly great value? And I'd say the market still doesn't fully understand that. The market loves hearing sound bites about buying royalties from telecommunications companies or hearing aid companies, but truly understanding the value of capital discipline and being able to find royalties that are completely below the radar and being able to do that consistently, I'd say the market currently ascribes almost no value to that. So I'd say that's another key area of our business that we're really trying to sort of get investors up the curve on.
Good to know that. Thank you. Great offering. Let's do, as we look towards the top of the hour here, we'll do one final question here, Spencer. And I feel called to ask your perspective from your seat at the company, looking down the road. Where do you see the royalty industry going in the next 5 to 10 years?
Look, I think the royalties industry is a fascinating sort of inflection point right now. I think any industry that's gone from 5 companies to 30 companies, in the space of the last 10 to 15 years, it goes through the same sort of growing pains. I think one analog you can look at, Mark, is if you look back 20 years ago at like the venture capital industry, you had basically a similar dynamic of 4 or 5 different large venture capital funds like the Sequoias of the world and some of their counterparts. And then now, fast forward to today, 20 years on, and you've literally got hundreds of venture capital firms. So I guess the scarce element is less so the capital now, and it's more about what's the value add, and I guess what else can we get from this company beyond just the hard dollars. And I guess I see a similar evolution happening in the royalty industry, where, if it's less so a question of, getting any check from a royalty company, and it's more a question of, why should I do a deal with this company? And, and in a lot of cases, being the first one to the deal is the edge. And if you're not the first one to the deal, you're in the back of the queue, and you're paying 3 whatever a multiple on the price.
Yes.
So I think where we see the industry evolving over the next 5 to 10 years is those that can consistently be first to the deal, or those that can consistently provide the most unique or innovative structure for the counterparty, they're going to continue to win. If you have a true differentiated sourcing edge or innovative approach to structuring deals, you will continue to win. If you don't, and if you choose the wrong assets and don't do proper technical due diligence, you will lose. So I think that's a sort of that's how we see some of the themes, headwinds and tailwinds in our industry over the next 5 to 10 years.
Beautifully said. I hear discernment in that offering, Spencer. Thank you for that. I have to say, I was very curious about your share today, seeing VOX join us for the VID conference to understand more about your company. I think you've done a spectacular job giving us a once around the shop, if you will, and some great industry perspective as well, just in terms of the next steps that we take. So I just want to thank you so much for all your time. And to everybody else that's watching right now, I want to say thank you for joining us. Spencer, all the best to you for the holidays. And those that are here with us until the top of the hour, we have Galway medals coming next. But do recall that we have a survey coming up as this session ends, and we'll see you at the top of the hour. Spencer, my very best to you again.
Thanks so much, Mark. It's been a pleasure.
All the best.